On a cold morning in November 1923, a woman walked into a bakery in Berlin with 1 billion marks in her purse. By the time she reached the counter, the price of a loaf had risen again. Her money was already insufficient. The floor didn't collapse under her feet, it collapsed under her currency. And yet the real tragedy wasn't the wheelbarrows of notes, it was the quiet understanding spreading through Germany that the state had lost control of value itself. People were told it was a temporary crisis, a passing fever, an unfortunate side effect of necessary measures. In reality, the crisis was designed into the very cure. Printing was sold as relief. It functioned as liquidation. And once the machine started, no one in power could admit the truth. Every new note was a confession that the old system was already dead. By the start of 1922, the Reichsbank was issuing marks at a pace that rewrote arithmetic. $1 rose from 190 marks to over 7,000. The official explanation was simple. Germany needed to survive, to pay reparations, to keep factories humming. That's the visible event, the public rationale. The hidden mechanism was brutal. Berlin was quietly choosing to destroy savers in order to preserve the state. It wasn't declared policy. It was the only lever left that didn't require foreign permission. Someone always pays. And in Weimar, the bill landed on the people least able to avoid it. This wasn't chaos. This wasn't mismanagement. This was the cost of running out of options. And that was only the visible part of the deal. The moral tension didn't begin with inflation. It began with the treaties that boxed Germany into a mathematical corner. 132 billion gold marks, a sum calibrated not to be repaid, but to be obeyed. International creditors demanded hard currency. Domestic politics refused hard austerity. Between the two was a gap so wide that only the printing press could fill it. It was the perfect trap. Berlin could either trigger mass unemployment or mass inflation. They chose ink over riots, knowing exactly who the ink would dissolve. On paper, printing looked like sovereignty in action. In practice, it was the surrender of monetary power to panic and political survival. A government unable to raise taxes without collapsing. A workforce unwilling to accept wage cuts. Creditors enforcing payments that couldn't be met. Each group behaved rationally on its own terms. Together, they created a system where the only solution deepened the disease. By January 1923, when France and Belgium occupied the Ruhr to extract reparations directly from German coal and steel, Berlin escalated the mistake. Visible event. Workers were ordered to resist, to strike in patriotic unity. Hidden mechanism. The state paid millions of striking workers with money it didn't have, printing marks against zero productivity. Irreversible consequence. The mark began its final collapse, not in the streets, but in the accounts of the Reichsbank, where every solution accelerated the implosion. This wasn't national pride. This wasn't resistance. This was the moment the currency became a political hostage. And the hostage didn't survive. By July 1923, prices doubled every few days. By November, they doubled every few hours. The government kept printing because stopping meant immediate bankruptcy. The paradox was razor sharp. Every note they issued protected them today and destroyed them tomorrow. That is the true logic of hyperinflation. It is not a failure of discipline. It is the final stage of a system that has already run out of escape routes. The public saw a government trying to help. The real story was simpler. Printing became the only tool left when every other lever was politically or internationally forbidden. Officials knew what it meant. They saw the numbers. They read the cables. They understood that once the currency entered exponential decay, no human decision could slow it. But admitting that would have shattered the political order instantly. So they printed. This was survival masquerading as policy. This was arithmetic posing as patriotism. This was a nation burning its own money to buy time it no longer had. When the Rentenmark finally arrived on November 15, 1923, it didn't save Germany. It simply reset the scoreboard after the old game had already consumed millions of lives' savings. People were told the worst was over, but the irreversible consequence had already taken root. A population that had lost faith in the continuity of value, and a political landscape primed for extremism. Here's the part they never teach. Hyperinflation isn't a monetary phenomenon. It's a political verdict. It is what happens when a state decides, consciously or not, that its citizens' savings are expendable compared to its own survival. Then it was called emergency issuance. Today it's called quantitative easing, stabilization, liquidity intervention. The vocabulary changed. The leverage didn't. The final hours before a currency dies don't look like a disaster. They look like relief. In late 1922, when the Reichsbank pumped another 500 million paper marks into circulation in a single week, Berlin newspapers celebrated the move as stabilization. The public saw the visible event, money flowing again, wages paid again, markets unfreezing. What they didn't see was the hidden mechanism quietly locking the country into a fatal loop. Every new mark erased the value of every existing one. It didn't feel like destruction. It felt like breathing room. That was the trick. And that was only the first turn of the screw. By this point, the stakes were more than economic. They were existential. The government knew that failing to pay workers risked revolt. Industrialists knew that defaulting on foreign-denominated contracts would shutter their factories. Ordinary citizens knew that without wages, even collapsing ones, they wouldn't last the winter. Everyone was acting in self-defense. And yet, collectively, these survival choices formed a perfect storm. A currency forced into cannibalizing itself. Here is the moral tension nobody wanted to acknowledge. To save themselves, each group had to sacrifice everyone else. The state sacrificed savers. Savers sacrificed consumers. Consumers sacrificed stability. Stability sacrificed the currency. Each step was rational. Together, they were lethal. By August 1922, the dollar passed 1,000 marks. A few months later, 4,000, then 70,000. The line wasn't curving, it was detonating. Politicians pretended it was temporary volatility. Economists claimed markets were repricing risk. But the hidden truth was mathematical. Once inflation enters compounding acceleration, it becomes its own engine. Stopping it requires political suicide. Cutting spending, raising taxes, defaulting openly. No government built on fragile coalitions will choose that. Weimar certainly didn't. This wasn't cowardice. This wasn't ignorance. This was political survival overriding numerical reality. And the numbers don't forgive. The most dangerous moment came not when prices rose, but when people realized they had to protect themselves faster than their government could protect them. That's when the system broke at the behavioral level. Workers demanded twice-a-day wage payments by mid-1923. Landlords rewrote leases in gold equivalents. Farmers hoarded grain because selling it for marks was like trading crops for falling sand. The public story was that Germans were panicking. The hidden story is that they were adapting, faster than the state could. And once a population switches to survival mode economics, the currency collapses on contact. Because no government, no matter how powerful, can enforce value on paper that nobody wants. By May 1923, weekly inflation was over 500%. Think about that. A loaf of bread costing 30 marks on Monday cost 180 by Sunday. The state responded with what it claimed was stabilization, printing more notes to keep up with price levels. This was the point of no return. When a central bank prints money because prices went up, not to create output, it becomes the chaser, not the driver. Hyperinflation isn't when prices rise. Hyperinflation is when the government follows those prices with a printing press. In theory, printing was supposed to reassure the public. In practice, it confirmed their worst fear. The state was no longer in control. This wasn't support. This wasn't stimulus. This was validation of collapse. And yet, the true betrayal came from the international side. Creditors, banks, and foreign governments watched the mark disintegrate and interpreted it not as a cry for help, but as proof of German unreliability. Their response was predictable. Tighten loans, raise interest demands, reduce credit lines. Weimar tried to print its way out of domestic pressure, but the global financial system punished it for the very act of trying to survive. Visible event: Germany prints to avoid revolt. Hidden mechanism: creditors withdraw support at the first sign of weakness. Irreversible consequence: Collapse accelerates from inside and outside simultaneously. By summer 1923, the mark didn't fall, it evaporated. $1 reached 350,000 marks in July, then 20 million in August, then 620 million in October. Those aren't numbers, they're distress signals from a state dissolving in real time. Here is the logic almost nobody understood at the time. When money loses its function as a store of value, it stops being money. It becomes a consumable. People spent notes immediately because waiting an hour meant losing purchasing power. That behavior, rational behavior, destroyed monetary velocity limits and turned hyperinflation into an unstoppable avalanche. You don't need riots to collapse a system. You need people acting rationally in an irrational environment. That's how currencies die. And once again, the lesson echoes forward into today. In Weimar, printing was described as temporary emergency financing. Today, it's called quantitative easing, liquidity backstops, and market support. In Weimar, workers demanded faster wage adjustments. Today, markets demand faster policy reactions. In Weimar, the currency chased prices. Today, governments chase market expectations. Different century, same physics. The danger didn't start when Weimar printed too much. The danger started the moment printing became politically easier than confronting reality. Every nation has that moment. Most don't realize they've crossed it until the ground gives way. The collapse didn't start with worthless notes. It started with a whisper. The mark won't hold. By early 1923, that whisper had turned into arithmetic. When German factories demanded payment in foreign currency just to keep machines running, the public still believed they were dealing with inflation. But the truth was sharper and far more terrifying. The mark had already ceased to function as a unit of account. Prices weren't rising. Prices were abandoning the currency. The visible event was simple: shops updating chalkboards 3 times a day. The hidden mechanism was darker. Every merchant, every landlord, every foreman had switched to psychological pricing. They weren't calculating mark values anymore. They were calculating how quickly the mark would die between breakfast and dinner. Once a nation starts thinking in hours instead of months, the currency is already gone. And yet the government insisted the printing was protection, that wages would stay afloat, that the state could outrun the collapse by flooding the system with liquidity. But flooding isn't rescue, it's suffocation. 50 quadrillion paper marks issued in 1923 didn't support the people. It dissolved their time, their labor, their future. Printing made the collapse visible. But the collapse had been decided earlier, when the state chose expansion over confrontation. This wasn't ignorance, this wasn't miscalculation. This was the survival instinct of a government with no other tools left. And the price was national memory. One of the most catastrophic shifts came in April 1923, when university tuition fees, once stable for decades, began doubling weekly. Educated families, the backbone of civil society, saw their savings crumble into dust. Teachers demanded salaries paid daily. Students dropped out in waves. A civilization that had defined itself by scholarship discovered that knowledge could not be denominated in a dying currency. Here's the hidden consequence no politician dared speak aloud. Hyperinflation doesn't just destroy money, it destroys trust in every institution built on that money. Schools, courts, contracts, savings accounts, all scorched in the same fire. And that was only the visible layer. By June 1923, something irreversible happened. Germany's industrial barons, Krupp, Thyssen, Stinnes, stopped thinking in marks altogether. Their accountants ran numbers in dollars, pounds, francs. The business elite abandoned the national currency in private, even while defending it in public. That's the moment the system crossed the event horizon. When those with real economic power exit the currency mentally, the collapse becomes inevitable mathematically. Visible event: factories demanding foreign-denominated contracts. Hidden mechanism: the elite quietly defecting from the mark. Irreversible consequence: the state losing the last constituency capable of stabilizing it. The public thought inflation was a storm. The elite treated it as a regime change. Meanwhile, inside the Reichsbank headquarters, another moral tension tore the institution apart. President Rudolf Havenstein insisted that printing was necessary to avoid unemployment and starvation. Critics inside the bank warned that the presses were mathematically guaranteeing collapse. Both sides were correct. That's what made the trap so perfect and so deadly. Stabilizing the mark meant wrecking the economy. Saving the economy meant killing the mark. They didn't choose badly. They were presented with a choice where every option was fatal. By August 1923, the average worker earned wages in the morning and spent them the same hour, often buying goods they didn't need: soap, nails, rope, anything that wouldn't lose value by lunchtime. Money wasn't a medium of exchange anymore. It was a melting ice cube in human hands. And once people behave that way, the economy stops functioning altogether. You can't plan, you can't price, you can't save, you can barely survive. Every system has a moment where logic breaks. For Weimar, that moment was when the velocity of money outran the velocity of production by a factor so large the numbers stopped meaning anything. A loaf of bread cost 250 marks in January, 20,000 in June, 1.5 million in September, 80 billion in November. These weren't prices, they were warnings. Hyperinflation is never about numbers. It's about the collapse of time preference. It's about a society discovering that tomorrow has no meaning. And here lies the modern echo, the part governments hope no one notices. Then, people spent money the moment they got it because it would lose value by evening. Today, markets demand instant intervention because any delay triggers panic. Then, the currency lost the ability to store value. Today, central banks lose the ability to stop printing without imploding the system they built to protect. Different mechanisms, same corner, same logic, same fear hiding behind different vocabulary. The moment the presses became unstoppable wasn't when the Reichsbank ran them day and night. It was when turning them off threatened the government more than letting the currency die. By September 1923, Germany had crossed the line into pure monetary dependency. Printing wasn't policy anymore. It was anesthesia, pain relief that guaranteed a deeper wound. The visible event looked almost heroic, the government announcing new wage supports, new credit programs, new emergency funds. It sounded like action. It sounded like leadership. But the hidden mechanism was devastating. Every support program was financed with money born that very morning. The state wasn't allocating resources. It was fabricating them, hoping the illusion would stabilize reality for just one more day. This wasn't stimulus. This wasn't governance. This was crisis management performed with a detonator in hand. And that was the moment the system truly inverted. The political class discovered a terrible truth. Printing solved immediate problems faster than any alternative. Need to pay striking workers? Print. Need to replace lost tax revenue? Print. Need to stabilize markets? Print. In the short term, printing avoided riots, bankruptcies, and political collapse. But beneath the surface, it hollowed out the very foundation the government was standing on. Hyperinflation doesn't begin when a government prints too much money. Hyperinflation begins when not printing becomes more dangerous than printing. That is the psychological trap Weimar fell into. And it is the trap modern governments pretend doesn't exist. By October 1923, the mark had entered a state economists later called suicidal momentum. Every new note lost value faster than it was printed. Factories demanded prepayment in dollars. Landlords indexed rent to gold. Farmers refused to sell at any mark price. The nation fractured into microeconomies, each running its own rules to escape the burning core. Visible event, the currency collapsing in public. Hidden mechanism, society privatizing value in the shadows. Irreversible consequence, the state losing the ability to govern anything denominated in its own money. When a government cannot enforce the meaning of its currency, it is not a government anymore. It is a spectator with a printing press. And the moral tension sharpened to a point that could cut through steel. The only way to stabilize the mark was to stop printing immediately, impose brutal austerity, fire millions of workers, admit national insolvency, and accept foreign control of the economy. No elected leader could survive that. So they did the only politically survivable thing. They printed more. They were not choosing between good and bad. They were choosing between collapse today and collapse tomorrow. And tomorrow kept winning until nothing was left. One of the most disturbing statistics of the entire crisis came on October 26, 1923, when the Reichsbank issued 1.2 sextillion marks in a single day. That number is mathematically absurd, 1,200,000,000,000,000,000,000,000. But the true horror isn't the quantity, it's the meaning. Even that astronomical flood failed to stabilize prices for more than a few minutes. Printing had lost its power. Paper had lost its purpose. Money had lost its identity. At that point, the government wasn't inflating the currency. The currency was inflating the government, forcing it to take actions that made the crisis irreversible. And here is the part modern policymakers refuse to confront. When a state becomes dependent on money creation to survive, it loses the ability to use money creation as a tool. It becomes a hostage. It becomes Weimar. Then, emergency printing was justified by patriotic necessity. Today, it's justified by market stability, systemic liquidity, and financial plumbing. Then, stopping the presses meant instant collapse. Today, stopping stimulus triggers seizures in the debt markets built on that stimulus. Different vocabulary, same physics, same addiction dressed in new language. By late October, Germany had reached the point of no return. The money supply was expanding faster than human comprehension. The currency was no longer collapsing by the week or the day or the hour, it was collapsing by the minute. And the final tragedy was that most Germans didn't realize the worst moment had already passed. The real catastrophe wasn't the day the mark hit zero. It was the moment earlier, invisible to the eye, when the state lost the choice to stop. The same moment every modern system fears. The same moment every analyst denies. The same moment we are beginning to approach. The most terrifying thing about Weimar isn't that it happened once. It's that the mechanism wasn't German. It was universal. By November 1923, when a loaf of bread cost 80 billion marks, the world pointed to Germany as a cautionary tale. But what no one admitted was this. Weimar didn't fail because Germans were reckless. Weimar failed because its financial structure was identical to what every major power now uses: debt-backed money, deficit-backed stability, political promises backed by printing. Visible event, a German tragedy. Hidden mechanism, a blueprint. And that blueprint didn't stay in Europe. It became global monetary doctrine. The modern system learned the wrong lesson. Instead of concluding, don't print without limits, policymakers concluded something far more dangerous. Don't let your currency be the one everyone dumps. They didn't eliminate Weimar logic. They industrialized it. Here's the shift Weimar never had access to: the invention of the global reserve currency. When the dollar took that role in 1944 at Bretton Woods, the United States inherited an escape hatch Weimar never had. America could print, and the world would hold those dollars as reserves. Germany printed, and the world fled the mark instantly. That difference saved one system and doomed the other. But the physics remained the same, and physics has a limit. By 1971, when Nixon ended gold convertibility, the last restraint snapped. Money became debt. Debt became the foundation. And the Federal Reserve gained the power Weimar leaders would have sold their souls for: the ability to print a currency the world must accept. But here is the hidden mechanism, one that's finally coming into view a century later. A global reserve currency delays Weimar. It does not prevent it. The moment the system requires permanent support, permanent liquidity injections, permanent stimulus, permanent debt rollovers, the system is no longer stable. It is balancing on momentum, not structure. And momentum always ends the same way, with a sudden, violent stop. Look at the pattern. 2008, the first bailout that couldn't be unwound. 2019, repo markets demanding constant intervention. 2020 to 2021, trillions printed in months, normalizing the impossible. 2022 to 2023, inflation globally synchronized for the first time in human history. 2024 to 2026, debts growing faster than GDP in every major economy simultaneously. Different nations, different leaders, same mathematics. And inside that mathematics sits Weimar's ghost. Back in 1923, the Reichstag passed emergency budget after emergency budget, insisting each one was temporary. Today, governments create multi-trillion-dollar deficits as recurring obligations and call them extensions, continuations, stabilizations. Then Germany claimed printing was necessary to preserve the economy. Now policymakers declare liquidity essential for market functioning. They're not wrong, but they're not in control either. The visible event, stimulus, support, liquidity. The hidden mechanism, systemic addiction to money creation. The irreversible consequence. The moment printing stops, the system breaks, just like Weimar. In 1923, the German government couldn't raise taxes fast enough to keep up with obligations. Today, no major economy can raise interest rates high enough to slow inflation without triggering sovereign debt crises. The tools are different. The trap is identical. Every solution worsens the disease. Inflation up, print less, collapse markets. Markets stressed, print more, accelerate inflation. Debt costs rising, cut spending, political suicide. Don't cut spending, financial suicide. This wasn't Weimar's failure. This was its architecture. Here's the part that should make anyone paying attention sit up straight. In 1923, Germany printed marks to pay domestic obligations. In 2026, major economies print to support a global system they can no longer slow down. Weimar printed for one nation. Today's central banks print for the entire world. The stakes aren't national anymore. They're civilizational. And yet the most chilling similarity is the psychological one. Weimar officials knew the system was collapsing long before the public did. They continued printing not out of madness, but because they saw the alternative, and it was worse. Today's financial leaders do the same. Listen to the hesitations. Look at the emergency meetings. Watch how every temporary intervention becomes permanent. Nobody believes we're going back to pre-crisis balance sheets. Nobody believes deficits will shrink. Nobody believes interest rates will normalize. They just don't say it out loud. Because once the public realizes the currency has entered irreversible dependence on printing, the clock starts ticking. And the tick is always faster than expected. Weimar teaches one lesson above all others. A system built on expanding money must expand forever or implode instantly. And the question facing us now isn't whether governments will print. They already are. The question is whether the global system can survive the moment printing stops being optional and becomes mandatory. That moment is closer than anyone admits. Collapse doesn't begin with a bang. It begins with a rule changing quietly. So quietly, most people don't notice it until it's irreversible. In Weimar, that moment came when the Reichsbank realized it couldn't stop printing without detonating the entire economy. Not shouldn't, couldn't. The presses weren't policy tools anymore. They were life support. Every modern system is inching toward that same mechanical point. By late 1923, one number revealed the truth with surgical clarity. Tax revenues covered only 8% of government spending. Everything else, salaries, pensions, military costs, railways, coal subsidies, came from fresh, unbacked money. The government wasn't funding the nation, it was hallucinating funding. Visible event, the state distributing emergency payments. Hidden mechanism, the state funding itself with currency decay. Irreversible consequence, stopping the decay meant stopping the state. And that is the moment when a currency is already dead, even if people are still using it. Here's the part Weimar's textbooks never emphasize. The collapse was not triggered by madness or delusion. It was triggered by a structural dependency. By 1923, every institution in Germany, businesses, cities, unions, ministries, needed constant liquidity injections just to stay afloat. Remove the injections, and the entire system would seize like a starved engine. The same dependency now exists globally. It's just hidden behind more sophisticated language. In Weimar, they called it Notgeld, emergency money. Today, it's QE, swap lines, repo facilities, liquidity operations. In Weimar, the state bailed out workers. Today, central banks bail out markets. Same function, same logic, same trap. Look at the timeline of modern interventions. 2008, liquidity injections prevent systemic failure. 2020, multi-trillion-dollar printing prevents total shutdown. 2023-2025, rolling back these measures proves impossible without markets convulsing. 2026, governments cannot reduce debt without triggering insolvency. Central banks cannot tighten without breaking bond markets. Markets cannot survive without liquidity. This is not policy. This is dependence, and dependence has a mathematical endpoint.
Here is the key insight, the one that separates Weimar as a historical event from Weimar as a modern warning. Hyperinflation begins not when a government prints too much, but when it cannot stop. In 1923, printing was the only way to meet obligations denominated in a currency nobody trusted. Today, debt is the obligation, and new money is the only way to roll it over. Governments don't print to spend, they print to survive. They print to prevent the largest debt structure in human history from collapsing under its own weight. Weimar scaled the problem to one nation. We scaled it to the planet. By mid-1923, every German mark in circulation represented an IOU issued against nothing, a ghost claim, a placeholder for value long gone. In 2026, most sovereign debt functions the same way, a forward promise backed by more forward promises, a cascade of obligations that require perpetual expansion to remain solvent. Expansion becomes survival. Survival becomes doctrine. Doctrine becomes trap. And once the trap forms, the public's behavior accelerates the collapse. In August 1923, average Germans stopped holding marks for more than a few hours. Today, investors rotate capital in microseconds. In Weimar, people bought goods immediately to escape losing power. Today, markets front-run policy announcements before the announcements occur. Hyperinflation isn't about printing. Hyperinflation is about expectations outrunning the state. When expectations move faster than policy, the currency follows them off the cliff. And here is the chilling continuity. When the state needs infinite money to function, it will always choose survival over value. Weimar did. Every modern government will too. By October 1923, Germany faced an impossible equation. Stopping the presses would cause mass unemployment, mass hunger, and instant political collapse. Continuing the presses guaranteed monetary collapse. So they did the only thing they could. They printed until the currency dissolved underneath them. That is the Weimar moment, not the wheelbarrows, not the billion-mark notes, the moment the machine locks itself into a path no one can alter. And the world is approaching its own version of that moment, not nationally, but structurally. The global economy cannot function without constant liquidity. Central banks can no longer withdraw support without detonating the markets they now sustain. Debt cannot shrink without triggering defaults that cascade across continents. The modern world isn't risking Weimar. The modern world is engineering it, slowly, silently, inevitably. Because the real question is no longer, will governments print? They already do. The final stage of collapse never announces itself. It doesn't come with sirens or speeches. It comes the moment people stop asking, is the currency stable, and start asking, how long until it breaks? Weimar entered that stage in November 1923, when Germans waited for the new Rentenmark, not because they trusted it, but because they had already buried the old one. The currency died weeks before anyone held a funeral. The modern system is inching toward that same unspoken conclusion. Visible event, rising prices, rate hikes, political arguments about deficits. Hidden mechanism, the realization, in markets, boardrooms, and governments, that stability is no longer assumed. Irreversible consequence. The moment confidence evaporates quietly, then all at once. The parallels are not poetic, they are structural. In late 1923, when the new currency arrived, people behaved not as if salvation had come, but as if they had escaped a burning building. They didn't cheer, they exhaled. They wouldn't trust money for a generation. A society that loses confidence in its currency doesn't simply recover, it mutates. And that is the part no modern government wants to discuss. Monetary trauma outlives monetary repair. After Weimar, Germans distrusted inflation for 80 years. They demanded hard money politics even in times of prosperity. Their memory became a political force stronger than any ideology. That's the kind of deep psychological scar that changes how a nation votes, saves, invests, and defines justice. Now imagine that scar on a global scale. Because here is the convergence no one wants to articulate. Weimar's trauma was national.
The next trauma will be international. The first hyperinflation created political extremism in one country. The next iteration could destabilize dozens, not because people are irrational, because people are rational. When trust dies, behavior shifts. When behavior shifts, systems fail. That cycle is already visible. In 1923, Germans bought goods immediately because waiting meant losing purchasing power. Today, investors chase assets instantly because saving in currency feels like holding a melting block of ice. In 1923, the currency collapsed because expectation outran policy. Today, policy lags markets by weeks, months, sometimes years, and markets move at the speed of algorithms. This isn't speculation, this is momentum. And the truth sits in a single, devastating sentence. A global system that requires infinite expansion cannot survive a finite world. Weimar hit the limit of what its currency could absorb. We are hitting the limit of what the global dollar debt system can absorb. Here is the mechanism nobody wants to say aloud. When debt becomes the foundation of value, and printing becomes the foundation of debt, the system has only two possible outcomes. Either permanent inflation, where currencies slowly dissolve year after year, or sudden hyperinflation, when confidence breaks in a single catastrophic snap. Both outcomes follow the same logic. Both outcomes come from the same architecture. Both outcomes were visible in Weimar long before the wheelbarrows. And both outcomes are already shaping the world we live in. The final shock of Weimar wasn't economic, it was psychological. When the new currency arrived, Germans realized something horrifying. They had survived the collapse, but the collapse had changed them. They no longer believed in economic guarantees. They no longer trusted political promises. They no longer assumed their government would protect their savings. That realization didn't fade, it metastasized. What happens when billions of people experience that same moment? When the next monetary reset arrives, not local, not national, but global, what will the world conclude about the institutions that guided it? What will nations do when trust in value itself fractures? What political orders will emerge from that fracture? Then it was called Weimar Germany. Tomorrow it may be called something else entirely. And here is the most important and most uncomfortable truth of all. Hyperinflation is not a monetary event. It is a political judgment. It is the moment a society decides that its rulers have failed. Not failed at budgeting, failed at legitimacy. That is why states fear inflation more than war. That is why they paper over crises with money. That is why they deny the trap until they are already inside it. In 1923, Weimar pretended printing was the solution. In 2026, the world pretends the same. But printing solves nothing. It only postpones the reckoning. And every day the reckoning grows larger, sharper, and harder to escape. Because the one lesson Weimar screamed into the future is the lesson the present refuses to hear. A currency cannot outprint truth.